Hi, welcome once again to this channel, Forex with Tutabo. And in today's discussion, we're talking about trading psychology. Now, this is one aspect of Forex trading that a lot of people tend to ignore. Even with my old training, all the money I spent to learn the Forex market, I wasn't taught this. Wasn't taught this. I learned this on my own. So I'm be sharing this with you so you don't lose your capital so you can be sustainable in the forex market. So, but before I go on to discuss the trading psychology, the mindset of a trader, what to do and what not to do to sustain yourself in the forex market, I quickly want to run through the types of traders so you can identify where you want to belong, where you want to fall under to maximize your profits. So basically, we have three types of traders. We have the scalper, we have the intraday trader, and we also have a swing trader. Now, a scalper is someone that trades not for a long time, doesn't hold a trade for a long time. For example, you can enter a trade right now, and in the next 30 minutes, you're out of that trade. That is a scalper. A scalper can trade as much as 20 or 30 trades in a day. It depends on how many sets set up the person sees. So basically, this is what I can tag hit and run. The scalper is someone that does hit and run. So for example, you see a setup on USD against the Canadian dollar. He sells on the open of a 1 hour candle, and that's 1 hour candle goes all the way bearish. He closes it and he has his profit. Most scalpers use a very high lot size to maximize their profits because they know they won't be staying long in the market. So they won't be getting a lot of pips. So what they do is with that small pips, even with as low as 10, 20, 50 pips, a scalper can have a lot of money because he increases his lot size. So that's the scalper. A scalper aims for not so much um, pips, but he increases his lot size. If it doesn't increase the lot, it can even use the same lot size, but it enters it so many positions. It can maybe for one trade, you can enter about 2 or 3 positions. And then after that candle forms the way he wants, he's in profit, he closes and is out. So a scalper is majorly someone that hits and runs. Hits every maybe 1 hour, you can decide 1 hour candle, 15 minutes candle. Just immediately he sees his profits, he's good with his profit. He closes the trade manually. He doesn't even wait for take profits and he's out. So that is a scalper. Now, an intraday trader, this is basically someone that holds a trade for like maybe a day, 2 days, 3 days, 4 days. These are intraday traders. For example, earlier this morning I called a sell on the USD against the Canadian dollar and it went boom. So a lot of people would have made money from that. So basically, for an intraday trader, so for a scalper would have closed. I called that position at exactly 8 o'clock on the open of the 8 o'clock candle, on the 1 hour candle, and it sold and it went all the way down. So a scalper could have easily closed and off. He has hits and he's out. But an intraday trader, because that particular position is something I see that is going to sell for a long time. The market is going to be bearish. So an intraday trader would not close that position today. He's going to wait for it to go down maybe by today is Tuesday, yeah, Wednesday. You can close Wednesday, he's an intraday trader. You can close Wednesday or you can close on Thursday or Friday, he's an intraday trader. So basically, intraday trader holds trades longer than a scalper. So he gets more profit. He gets more pips rather. The profits I can't say about that because it depends on your lot size. A scalper can decide to use a very high lot, a very high lot size, and he even gets more profits than an intraday trader. So an intraday trader holds trade for a longer time, and it tends to get a some more pips than a scalper. So that's an intraday trader. And then lastly, the a swing trader. These are, as the name seems, swing. They swing the trade all along. So these people hold trades for as long. I've seen someone that has been holding gold for as long as late last year. He bought gold and he has been holding that position and is in a lot of money. So mostly swing traders, they enter a position, they buy or sell, and they hold that position for a long time, 5 months, 6 months, 8 months, 10 months, a year. They hold that position. Now, swing traders, these people they don't enter a lot of positions. They don't open a lot of positions. It can just only be, can be just one trade that they even have running. Now, these people, they get as much as 2,000 pips, 1,000 pips, depends on how far the market moves. It's just the power of holding a trade for a long time. Because some of us don't have the mind for that. We don't have the patience to hold trade for that long because we are scared that it might reverse at any time. So basically, those are the types of traders: a scalper, intraday trader, swing trader. So you decide which you want to be, which you want to fall under, and you make up your mind. You stick to your principle because regardless, they all make profits. Just a matter of timing and a matter of the volume, how many pips they get. So that is the types of traders. So I'll be going on to the main discussion of today, the trading psychology. Trading psychology, very important, very important. What is your mindset to trading? What is your mindset to trading? Now, I'm sure you must be very, to have come to this stage, doing your demo, you must be aware of the risk in the forex market. You lose some and you gain some. Now, it is very important that your profits should be more than your loss. It's all right to lose. A loss is a part of the game. Loss is a part of the game. But when you do, you get up, dust yourself up, look for a better setup, and then you try again. You try again. Now, basically, trading psychology is just how you react to a loss, the mindset of a trader. Now, a lot of people, once they see that they've lost, they become eager, they become anxious, they want to get the money back, and then they make more mistakes. So all of this makes up the trading psychology, and then the things that you need to do and not to do to be sustainable in the market. That's what we'll talk about in this series of discussion. Now, the trading the forex, actually, I haven't seen a lot of correlation between trading and being a very good forex trader and being intelligent. You get first class, you get second class. That one don't concern the forex market though. Major thing that I have seen, that I know that is concerned for the forex market is your emotional control. How well can you control yourself? How well can you control your emotion? It is very critical to the survival in the forex market. Now, the market doesn't care about your emotions. It doesn't care if you had a heartbreak, if your boyfriend broke up with you. It doesn't care. The market is going to do what it's going to do. So you have to be ready for that. You have to be ready for that. And also, do not always rely on the result of your last trade as a forex trader. Because last week you made as much as you made over 500,000. You're confident. You're sure, I'm not going to lose this week. Treat every new week, treat every new setup as an independent setup. Do not rely on the fact that you had profits last week. You're going to have profits this week. So control your emotions. Control your emotions. Very, very important. That's the way you be sustainable in the market. So quickly, I would be going on to the points I've highlighted in the slide. As you can see, trading psychology. Number one, always and always and always use a stop loss. I won't tell you that for my 4 years of experience in trading the forex market, it is very important to use a stop loss. Now, some of you that have been following my series, some of you that are on my group, I have a group chat on WhatsApp. A lot of people are there. Some of you will notice at times when you place a buy on a particular trade, place a buy. It's of course buy bullish. Expect market to go up, and then you place your stop loss below. Here's what the market does. At times, the market will go down, hit your stop loss, and then it goes back up. So I'm sure you would have noticed, some of you that it has happened to you. You've not told me yet, but you'll be like, maybe I shouldn't even put this stop loss at all. Maybe I shouldn't. Maybe I should remove this stop loss. But put stop loss at every point. If it happens that way, that is not your deal. Let it go. Don't chase after it. Always use a stop loss, because it's every possibility. Now that's that scenario I painted, that it comes down, hits your stop loss, and then goes back up. It doesn't always happen that way. There are times that might be, it might be 10 out of 100 times that happens. It might be 10 out of 100 times that happens. Now, there's something called a stop hunt. Talk about that now. Talk about that now. I'll show you how to identify a stop hunt, so you don't fall a victim for a stop hunt. So always use a stop loss, regardless. And when it hits your stop loss, no problem. Dust yourself up, and look for a better setup, and you're going to make it back. So please, I'm saying it again. I, for one, I've been a victim of that. My first, second, even my third year, I think it was late last year, I started making some good profits from the Forex market. I have made a lot of loss. And what happened? Some of these things I'm going to be highlighting. As I said, these are some of my mistakes that I want to talk about in this series. These are some of my mistakes. There are some times where I wouldn't have a stop loss in place. And then I'll see the trade, I'll see it coming down. Maybe I'll have a buy. I see it coming down and it's about to hit my stop loss. I say, if it hits my stop loss and start going back up, this is going to be so painful. So I'll remove my stop loss. And when I remove my stop loss, it continues going down. And at the end of the day, margin calls, I lose all of my capital. So please, I beg, use a stop loss. Now, the second point is called secure the bag. Now, this is a term I'll use this term to try and portray a point, which is basically when you're on a deal, when you have a trade running and you're in profit, secure the bag. What does that mean? Bring your stop loss into profit. So that way, if the market wants to reverse, it is a crime for your win, for your profit to turn into a loss. I am saying it. Whatever Emmanuel is saying it. This is a crime. It's an offense for your profit. I'm sure some of you would have noticed in your demo account, at times you place a sell on a transaction, place a sell, and it starts going down. You're in profit, you're happy, and then it turns all the way up, goes back up, and hits your stop loss. It pains you, yeah? So what I'm going to tell you is secure the bag. Once the market moves, secure the bag. Bring your stop loss. If you're selling, this is your entry price. You're selling, market has started moving down. Secure the bag. Move your stop loss. You have a stop loss somewhere here. Modify your order. Click on modify order and look for a price below your price. Now, what do? Now you modify and then bring your stop loss and put it down here. So you put your stop loss in profit. You can even put it in your entry price so that you are to break even. So that if the market decides to reverse, if you put it in profit below your entry price, it will come back and hit that stop loss, and then you go out of that transaction in some profit. But you can put it at the same level of your entry price. So if it reverses, it comes back and hits your entry price, and it takes you out at break even. Break even, you know what that means? That means you do not lose, you do not gain at $0, $0. So it is better for you to break even than for your profits to turn into loss. It is a crime, and I will not accept that crime. If you're one of my followers, if you're one of my subscribers here, I will not accept that. That is punishable. So very, very important. Always secure the bag. I use an example of the sell, and I'm going to use another example of the buy. You're buying. You have your buy here. You have your stop loss. You have your take profit way above. Now the market starts to move. Immediately, the market moves this way. What do? Bring your stop loss and put it in profit. Profit, or you can put it at your entry level, at your entry price. So that way, when the market decides to do like Olori Buruku and start coming down, it can hit you either in profit or it hits you at break even, and it can decide to start going down. So you do not lose. It doesn't hit your stop loss. So always secure the bag when you've seen some good profits. Secure the bag. I'm going to make a live demonstration. Let me go to my MetaTrader 4, show you with some diagrams, show you what I mean. Okay, great. So here's an example right now. Perfect. I even had a buy open on GBP USD. So this is a perfect example. So now I bought the Great Britain pounds against the US dollar. At this point, this is my entry price. You can see it, buy, entry price. And I have my take profits way above here and my stop loss here. So now this is moving and I am in profit. I'm in profit of how much? It's about 1,018 naira. So what do I do right now? I'm in profit and this is my entry price. I will modify this order and bring my stop loss from here to profits above my entry price, either on my entry price or above my entry price. So if it decides to come down, I will not lose. It's going to take me out. It's going to, if the market decides to retrace, decides to come all the way down, it's going to hit my new stop loss, which is in profit or at the break-even point. So it doesn't come back and hit this. It doesn't take me out in loss. So let's do that together. Let's modify the order. Let's, first of all, on the chart, let's choose where we want our new stop loss to be. Remember, since we're buying, it has to be above our entry price. So you see this line. Come on. I'll bring it here. So I'm going to make my new stop loss 1.248895. So I have to go to the same thing if you're using your phone or your laptop, modify order. So impose the new stop loss. So I'm going to change it from 1.24410 to this. Let's do that. Let's change it to 1.2. Let's change it to 1.24895. Great. Modify the order. And boom, I have my new. Let me take this out so you see it. Great. So you can see this now. So I have secured my bag of money. So you can see my stop loss above my entry price, above where I bought. So if the market decides to come down, it's going to hit me and take me out in profit. It's better than going back and hitting me out in loss. So that is it. I just secured the bag. The same scenario in a sell setting. In the same scenario. This is the scenario in a buy setting. The same scenario is, let me use I don't have a position open here. But let me see if I can use that as an example. The USD against JPY is a good sell. I call that somewhere else. Though we caught USD against the Canadian dollar. But this is a good example of a breakout. I also told the people that are in my group about this. Let me do that. So if you've not noticed, gradually some people were asking some questions. They can't wait to start trading. You can start trading on your demo account. You can start trading if you have a live account. If you've been following, there's someone on the group that caught that move on the USD against the Canadian dollar on his live account. Someone that did, and he made a lot of money. So initially, in my previous discussion about on consolidation, I talked about consolidation. I talked about how markets ranges, how markets does a consolidation, and eventually the breakouts from that consolidation tells you the direction the market will go. So what happened in this example? I gave this example in my discussion on consolidation. So market was ranging for 1, 2, 3, 4, 5, 6, 7, 8, 9 days. And then what happened? This is the USD against the Canadian dollar, against the Japanese yen. So the market broke out. It broke out from this. It broke out from this range. And then once there's a breakout, market always comes back to retest that breakout. So I hope you're following, you're tagging along. So I'm already discussing some trading strategies. We have breakouts as a strategy to trade. So the market breaks out, gives you the direction of the market, and then it comes back. Once there's a breakout, there is always a retest. It comes back and does a test of where it broke out from. And it does this retest here. So a smart trader would have placed a sell here at this point, any of this point. So once you sell, it goes down, you're in profit. So let me use this as an example for to secure the bag. So let's say you sell here. So at this point, 107.2980. and then you have your stop loss here. Let me remove this rectangle. Okay, well, fine, let it stay. You have your stop loss here, you have your stop loss here. So now you sold at this point, and then the market does this move, does all of this move. Market is here right now, but even before the market go here, let's say at this point, when market was at this point, what would you have done? Secure the bag. You modify your order, and you move your stop loss, move it all the way to profit. You can either move it in profit below the entry price, or you can put it on the entry price. That way it takes you out at break even level. Takes you out at break even, so you don't lose, so it doesn't go back, it doesn't reverse and hit your stop loss. So this way you've secured the bag. It's a risk-free transaction. It's a risk-free trade. So you can have this running for as long as you can. You can have this running for as long as you can, and you can always keep doing that. If it moves again, you can always move your stop loss. If it moves, you can always move it. You can always move it as far as you want. You can move it so that if it decides to start reversing, it can come back and hit your new stop loss that is in profit. And instead of it's going to take you out in profit. So that's it. When you can still have your take profit way below, or you can remove your take profit, you can just, this is what we call it trail. You trail your profit. You trail it, you stalk it. At every point that it moves further down, you move your stop loss with it. You move it, but don't put it too close so it doesn't come and hit it too soon. So just continue trailing your stop loss. So that's it. That's for securing the bag. So please always secure the bag. Always do. So on the next point, your risk to reward ratio. Very, very important. What is your risk to reward ratio? Of course, you should want to risk little to gain more. What does that mean? The ratio of your take profit to your stop loss. The ratio of your take profit to your stop loss. Now, you enter, you are in a, for example, let me go back to my MT4 to show you that. So, of course, you sold this here, and you are expecting the markets to go all the way down. Now, ordinarily, you should be ready to risk. You should be risking less to gain more. You should be risking less to gain more. What does that mean? Your stop loss should be tighter, while your take profit should be bigger. So you are risking, if this, I'm selling from here, right? Now, if this deal decides to go up, if it decides to take me out in loss, let it take me out in loss here. I've not done a calculation, but this might be around 20 pips or 40 pips. So this is my stop loss. Of course, if you have this stop loss, you shouldn't then have a take profit around here. It doesn't make sense. It doesn't make sense. So that means if this thing hits if it hits stop loss, it's going to hit about $4 or $5. And then if it hits take profits, it's going to be hitting $2. That doesn't make sense. You are risking more to gain less. So what does that mean? Now, risk less to gain more. Now your stop loss is up here. Now your take profit should be somewhere around here. You can choose here, but let's make sure ensure your stop loss is smaller than your take profit. So you can have your take profit around here. So entry price, stop loss, entry price, your risk, your reward. So this risk to reward ratio makes a lot of sense. It does. You are risking less to gain more. Always have a good risk to reward ratio. It's part of the money management strategy. Always do that. You can always calculate it in pips. So you can say you are risking 50 pips to gain 150 pips, or you are risking 50 pips to gain 200 or 300 pips. That makes sense. That makes sense. So basically, that is the risk to reward ratio. Always use that appropriately. So also trading session. As a new forex trader, I'm sure you'll be excited. At every point you want to place a trade. Uncle, why? You mustn't place a trade at every point, at every time. Someone chatted me up and he wanted to place a trade yesterday around 10 p.m. I said, there's no point. Now it's now in our other. If you've not seen our discussion on the trading session, please you see it in our subsequent videos where I talked about the different sessions in the forex market. And I also advise on the best time to trade. The best time where the forex market has more volume. It is usually the London session, which is from our time about between 8 a.m. It opens at 8 a.m. and closes at I think 2 p.m. So either you're trading at the London session or you're trading at the New York session. Those are the best sessions to make. That's when you have a lot of volume in the market. Now, New York starts around 2. No, London doesn't end by 2. London ends around 5 or 4. Check my last video. You see it. I was detailed there. Then the New York session starts around 2 and goes all the way and ends around 10. So those two periods, I highly recommend you trade them now. And very important, at the lapse of the trading session of every day, at the end of the New York session for today, when the Sydney session Asian session wants to open the next day on Wednesday, within that period, within that interchange, there is always an increase in spread. There's always an increase in spread. So what does that mean? You shouldn't enter a transaction at that period. So remember what I said in my discussion about spread. The higher a spread is, the higher the commodity, the higher the currency is, the higher the cost. So if you have a very high spread, you'll be making more money for your broker than you're making for yourself. You have a high spread, spreads widen up as much as a spread that was about 2 pips can widen up to about 18 pips. Some even widen up to 100 and something pips. It's that serious. So avoid those trading sessions. Avoid placing a trade at those times in the night. Avoid those times. The spread is always widening up, always widening up. And when the spread widens up, if you have your stop loss not so far away, you can even hit it because of that sudden shift might hit your stop loss, and market hasn't even gotten to that point, but it has taken you out already. So please, very important, avoid trading at those times between the hours of 10 and 12. Between the hours of 9 and 12. Let's be safe. Usually I would have said 10 to 11, but avoid between the hours of 9 to 12. Avoid placing a new trade. If you have a trade that is running already, you can leave it. But when the spread opens, it might widen up and hit your stop loss. It might widen up and hit your stop loss. So spread always spike up during that period, during the interchange between New York session and the new trading session for the day, which is the Asian session. So very important. And also during Asian session, we have a lot of range. Market doesn't really move that much during Asian session, well, except for Australian dollar and New Zealand, and then the New Zealand dollar NZD. They move very well during those periods. They move well. Every other currency, every other commodity, they really don't move during that session. So New York and London is the best time to trade. So that being said, on to the next point: avoid weekend gap. There's something called gap. I don't know if I can show you in any of my charts. I don't know if I can see a gap. No. Let me see. Let's see if I can see a gap. Gap mostly happens. It mostly happens between during the weekends. Let me see if I can show you a gap. A gap is very bad because it might take you out. Boom, 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 boom. Where is you gap? All right, so here we go. Here we go on the USD against the Canadian dollar. There was this gap. You can see this was a Friday, and then over the weekend, market opened on Monday with a huge gap up. So imagine if you were selling on Friday and this happened. If you didn't have a stop loss, this might probably even blow out your account. You might lose the whole of your capital. But then if you have a stop loss around here, because at Friday, remember, all of this hadn't happened. So if you had your stop loss around here, so would have hit your stop loss, taking you out. Or if you're lucky, if you were buying and this happened, well, good for you. The gap up would definitely mean you would have jumped into profits, and of course markets continue to go up. So, but I advise people not to hold trades except swing traders though. Except swing traders, I advise people not to hold trades for over the weekend. So Friday, You see, you think you're good, think you've hit your weekly target, close your trade, because most weekends price opens up with a gap up or a gap down. It opens with a gap up or a gap down. So what causes this gap? Things happen over the weekend. Remember, these are currency exchange rates or price of commodities. Remember, the market closes on Friday and doesn't open up until Monday. So within Saturday and Sunday, a lot of things happen that influence values, that influence prices. So whatever must have happened on Saturday and on Sunday, the market opens up with that gap to get to the current level at which that price or that exchange rate is. Basically, that is why these gaps happen. If you look at your chart, you see them at a lot of points. You can, aside from this is USD Canadian dollar, you can run through your charts, look at other currencies, weekends, Saturdays and Sundays, So over to Monday, market opens with a gap. So avoid leaving a trade open weekends. It's most likely to gap and hit your stop loss. So let's move on to more discussions. So always use an appropriate lot size. You can hit me up if you have an account size and you don't have you're trying to know how much lot size to use. Hit me up. If you have $100 account, use a 0.01 as your lot size, please. Very important. If you use a very high lot size, you lose your capital faster. A lot of people will get greedy. Another factor in this market is greed. People want to make money fast. No, remember the principle of compound interest. Compound. If you continue to compound your money, your small daily target, if you continue to compound in a month, it is large. But some people want to get everything in a day. That's why they increase their lot size. You see someone with a $100 account and he's using 0.10, 0.10 because he wants to make all the money at a go. What happens? You might end up, if the trade doesn't go in his favor. It's very, very important, because in the market, always have the mindset that anything can happen. Nobody is 100% certain. Nobody knows the future. This is like what will happen next. Nobody knows what will happen next. But we just analyze and say, okay, this is what might happen next. Keep an open mind. Keep in mind that what if this trade doesn't go the way I want it to go? So if you have made a mistake, your village people whisper to you and you listen and you increase your lot size, you're going to lose your money. So always use an appropriate lot size. That's why I'm glad a lot of us now from my YouTube, from my WhatsApp group, we are still on there. So most of them, some of them have gone live, some are still on their demo. So now with your demo, I believe you'd have known how much you want to fund when you're going live. So you can use this chance for a demo to practice, to know the appropriate lot size that you should use. Well, I advise you to use between 0.01 and 0.05. Now practice. Now see what happens when you use these various lot sizes, and then see how they work. So very important. Always use an appropriate lot size. So and avoid inflating it because of greed, because you want to make all the money at a go. You might lose it all. So as for appropriate lot size, and also news, major events like news, they come up and they make the market go haywire. And so major news events come up at different times. Different currencies have their different economy, have their news that come up. And of course, remember, every economy news affects the economic currency. So earlier in one of my series, I posted a website where you can get forecasts. You can get news of what will happen today, what will happen tomorrow, what will happen all through the week. So major news that are going to come out that will affect those currencies. It's factoryforex.com. Factoryforex.com. www.factoryforex.com. So when you go there, you see folders. And let me see if I can open it quickly and show you. Okay, so here we are. www.forexfactory. Sorry, not for Factory Forex. Forexfactory.com. So you see the news, like today is Tuesday, April 28th. So you can see the news for today. These are the news for today. You have JPY at the different times they are going to come out. Now, the yellow folders indicates a low impact news. So this news will not really move the market, while the orange indicates a medium impact news. But when you have a red impact news, that is a high impact news. For example, today by 3 p.m., the US dollar has a major news coming up. So what does that mean? It means by every USD pair is going to be affected by 3 p.m. There's going to be a serious movement by 3 p.m. So you can see, you can even on this website, you can see what happens even on Wednesday. You can see what happens on Tuesday, all the way through the week. You can see Tuesday, Wednesday, Thursday, Friday. You see, that's all that happens. Even as much as next week, you can see the major news events that are coming up. So you can go to the website www.forexfactory.com to see the news that are happening. There are some people that haven't trade this news. Some people actually carry out analysis to know what each of these news will, what direction each of these news, major news, will move the market to. But hey, that's not our business for today. Our discussion right now is for you to avoid this news. Now, if you're in a transaction, if you're in a trade, for example, you're selling USD against the Canadian dollar, and it's almost 3 p.m. because by 3 p.m. we're having a major news on the USD. What do? You put your appropriate stop loss, or you can decide to close the trade, or you can as well decide to move your stop loss to profit to secure the bag, because the news might just send it all the way to the other direction, and it takes out your stop loss. So it's very important. You always look at that website, always check to know when a major news is coming, so you can decide if you want to close your position, if you want to secure the bag, or if you want to set your appropriate stop loss. So that's very, very important. Very, very important. So also, always have a daily target. Always have a daily target. The market is very big for everybody. The market is not running away. You can make the money today, you can make it tomorrow, next tomorrow. It's always there. So just set out that you want to make today. I want to make 20,000 naira. I want to make 20 US dollar. I want to make 50 US dollar. I want to make 100 US dollar. It depends on your capital. The more your capital is, the more your lot size, which is, of course, that's the more your profit. So you can decide you want to make 5,000 naira in a day. Decide you want to make 100,000 naira in a day. Always have a daily target. So once you hit that daily target, leave the market. The same thing goes for loss. As much as you have a daily target for profit, you can also have a daily target for loss. So you can say, once I hit $10,000 loss in a day, I am out. Go drink a cold bottle of Coke, refresh yourself, because it's very important. Your mindset is very, very important in the market. Always have a daily target. So you can decide it might be in naira. You can decide if I lose 10,000 naira in a day, I want to leave the market. I want to go back and relax, do your analysis again. Take a deep breath. Take that cold bottle of beer or a cold bottle of Hap or Legend. So you're good. Come back and then boom. So please, it's very important. Have a daily target. Once you hit your daily target, get out of the markets. Go and chill. Go and do something to cool your head off. So if you have a daily target, you can hit your daily target. You just imagine, do your math. You can on your own, with whatever capital you have in your mind, calculate your daily target. Calculate it in a week. Then calculate in a month, see how much you can make, instead of thinking you want to make everything in a day. And in a bid to make everything in a day, you end up losing. Now, me myself, I discovered, even up to now, I discovered, as I said, from the beginning of this discussion, not this series, from when I started my first video, I said, I'm going to try for you to learn from my mistakes. I won't try that, because even this daily target, I also struggle with it. But I'm going to tell you, don't make my mistakes. I discovered my last trade of the day is always my worst trade of the day. I've made enough money. I said, oh, I've seen this opportunity. This is going to sell. Let me do this. And then I eventually end up going into that trade. And it goes south, it goes north, it goes against me. And I end up closing it in loss. So always know when to leave. Always know when to take a step backward. Very, very important. So lastly, well, these are the things I can remember right now. I'll probably still have to do this trading psychology again some other time when I remember some of my mistakes, some things that are important for you in the market. So lastly, revenge trading. It literally goes hand in hand with the daily target. revenge trading is very, very bad. Avoid revenge trading. Revenge trading, you make a loss today. You lost $20, and you say, I have to make this money back. I have to. Your mindset is wrong at that point. At that point, you're not thinking straight. You're seeing what you want to see, not what the market is doing. At that point, you're seeing what you want to see. So you want to make that $20 back, and you place a buy, place a sell on a particular trade, a particular currency. It will most likely go south. It will most likely go against you, and you will end up losing more. So always avoid revenge trading. If you've lost for the day, take a step backward and chill. Come back later when you have a perfect setup. Very important. Avoid revenge trading. So people, I hope at this point we're going to call it a wrap for now. So I hope you got value for this, and thank you very much to my subscribers and everybody listening. But remember to hit the subscribe button if you've not subscribed, so you can get notifications when I release the next videos. So stay safe, take care of yourself. I hope we get to the advanced. Well, we are at the advanced stage now. Hope we get to the phase where we'll be talking about more analysis, so we can start making that money. So thank you very much. Remember to hit the like button. If you have questions, do ask them in the comment section. God bless you. Stay safe out there. Bye.